Welcome to the Citizens Monetary Policy Committee meeting. The global events may change things dramatically for the Reserve Bank and for its Monetary Policy Committee, which announces its decision on Thursday. Whereas during the June policy, the Fed was expected to cut rates by just 25 basis points once in 2024. Now the markets are expecting a 125 basis point cut in 2024 itself. So what should Reserve Bank and its MPC do? As always, CNBC TV18 Citizens Monetary Policy Committee meets to give us an idea of the issues before the RBI. I have with me Chairman of our committee, Dr. Pronab Sen, and members Kanti, Ghosh of SBI, Sajjid Chinoy of JPMorgan, Samiran Chakraborty of Citi, and Sonal Varma of Nomura. Gentlemen and Sonal, thank you very much indeed for joining us. Sajjid, first delineate the global scenario for us. Will it not be a pressure on the RBI and MPC?
Latha, good morning. I think this is the biggest change between the last monetary policy meeting and this one. You know, we've been making the case for global resilience for the last 2 years now. The global economy has been remarkably resilient. But that resilience was predicated on two phenomena. One, that the US exceptionalism would fade and Europe would start carrying its own. And the second was that the services, even as the services sector slowed, that manufacturing would recover and you'd get some kind of goods recovery. Both those hypotheses have been severely challenged over the last few weeks. We've seen very disappointing PMIs mid-year. If you take it literally, the global output goods index is down by 2.5 points, which means essentially global factory output has come to a stall, A. B, we've seen Europe has disappointed. So the US is the only growth engine. China has been disappointing. But I think most importantly was the crack in the labor market that we saw last week. I think what we're seeing now is that this is the fourth consecutive increase in US unemployment, and the SARM rule, so to speak, has been triggered, where the unemployment rate is now almost a percentage point, 0.9 percentage points higher than the cycle low. Yes. We also had last week, for the first time, only 49.6% of US businesses increase headcount. This number has only been below 50% once when you're outside of a recession. So there are ominous signs now that the global economy is not getting the resilience from manufacturing and from Europe. And that you're seeing cracks in the US labor market. It's too early to say that we're in the midst of a recession. This is only 1 or 2 data points. And remember, we had Hurricane Beryl, which may contaminate the last data. But no matter how you cut it, this is a worrying slowing of global momentum. And even if we avoid a US recession, given where the labor market is, given the slowing in the last few months, given how wages have slowed, given how core inflation has slowed, the Fed is offside by at least 100 basis points. So even if you don't get a recession, our sense is both in September and November, you get a 50 basis point cut. In fact, I think there's a strong case to be made from a risk management perspective that the Fed possibly even cut before the September meeting and not wait for things, because recessions are very nonlinear and you don't want to be caught on the wrong side of this nonlinearity.
Fair point. That's the market expectations for you running on the screen. 125 basis and 50 basis September can be advanced is what Sajjid is saying. Sonal, there is in addition a Chinese deflationary impact, which is perhaps already showing up for us in terms of low core CPI in India. You tell us, will the RBI need to change its inflation and growth forecasts already?
No, Latha. I mean, we think they'll maintain 4.5 on CPI and 7.2 on GDP. I think we did get an upside surprise on food, particularly vegetable prices, which means that the second quarter CPI forecast of the RBI, which is currently at 3.8, will need to get revised higher a shade. But since this is driven by vegetable prices, which tend to mean revert, and the positive progress on monsoons, which actually bodes well for the broader food basket. We think there'll be an undershoot on food as well as headline inflation in the second half of FY25. So very much on track despite the upside on vegetables and the expected pickup in telecom. I think most importantly, Latha, I think the RBI's concern has been that inflation is not aligning to the 4% target. Our view is inflation is already aligned to the 4% target. Core, all measures of underlying inflation have been sub 4% for quite some time. And given the crack we are are seeing in global commodity prices. It means that the increase we had seen in commodity price pressures is going to reverse going forward. And as Sajjid said, there's downside risk growing to US growth and therefore over time to India as well from a growth perspective. So no change as of now in terms of FY25 numbers, but downside risk to growth as well as to inflation over time, I think, have increased.
Okay. Well, there is another problem as well, the fight for deposits. Soumya, let me come to you with that. With the new LCR, liquidity coverage rules, the fight for deposits could get worse. Should the Reserve Bank think of a CRR cut even before a repo rate cut?
I think that's a very valid point because the issue with the deposits is now becoming more of a structural one. As you know that there in the budget also there has been some adjustment on the tax treatment of different asset classes. The most important point regarding the fact that the deposits are not growing. Deposits are growing, but not to the extent which credit is growing. For example, this year, even after last year, the deposit growth was 13.5%, which is a very healthy amount. This year, the incremental deposit growth has rupees 7 trillion as against 10 trillion last year, which is still a very healthy growth, but not as much, even if you look into the aspect that the deposit rates were hiked by several banks. The problem with the deposits, and I rightly pointed out LCR, is that deposit rates are unlikely to come off in a jiffy anytime now, because as long as you don't have a treatment of the deposits of uniform across all asset classes, I think it will be very difficult for the deposits to pick pace with the credit. And to your question of this CRR, I think that's a valid question because at the end of the day, as you know now, liquidity is now managed more on a real-time basis. We have been included in the bond index, so that makes the capital inflows also very volatile. That also makes and as you know that the government cash balance is now is a very important factor in the entire scheme of things, given the fact that government has moved into the JIP. That means that fund balances also will remain a constraining factor in freeing up liquidity for the banking system. So my sense is that it may be a good idea, and we have discussed this earlier also, that to make CRR and LCR as a cyclical to manage liquidity over a point of time, because in my sense, even if in hypothetically for the central bank wants to cut rates at some point of time in the future, it will be it may not give us still the signal that repo rates and lending rates will come down from the current levels.
Fair point. You know, we are getting carried away, Samiran, by the way in which there was a meltdown after the Friday jobs data. But otherwise, the financial conditions were actually described as loose. We had the SEBI chairman, we had the RBI governor, everybody speaking about, this F&O and, financial worries about financial stability. So can you develop on what Soumya is saying and how the MPC and RBI may approach financial conditions?
So Latha, first to start with, the crude indicator that everyone tracks is the banking system liquidity. And in banking system liquidity, we'll see that durable liquidity is now more than 4 lakh crores. And even the system liquidity, the frictional liquidity, the last print has been 2.7 lakh crores. So clearly, liquidity is, in that sense, ample in the system. And if you extend it further to a more broader financial conditions index, which will capture not just this liquidity, but also the short-term and long-term rates, the FX markets, the equity markets, the credit markets, everything. In fact, what shows up clearly in that index is that it tightened a little bit around April, May, but from there on, it has loosened up again till now. And then all through the while, I would say that by our understanding, these financial conditions have remained somewhat easy rather than tight. So in that sense, it is possible that the RBI can keep their stance as well as their policy rate unchanged for a longer time without being worried of the fact that they have over-tightened the system. And I think that's a very important thing to keep in mind, that we should not just be looking at the repo rate in isolation, but look at it in the overall context of where the financial conditions are.
Oh, absolutely. The liquidity, if you count what is with the government, 4 lakh crore. So where is the argument for a CRR cut? It's probably even for a hike. But Dr. Sen, the other big point which the Reserve Bank has to consider is the fiscal deficit, which has come down more dramatically than the Reserve Bank would have contemplated even in even in the June policy. So putting that and the other lead indicators we have of growth, what do you think the MPC should do? Remember, 2 people have already been asking that there should have been cuts already.
Well, Latha, it's not just what's happening to the fiscal deficit. What is important is that what the budget signifies is the overall fiscal stance. What the government considers important, what it doesn't, and what the macro dynamics arising from that are likely to be. Now, if you look at it in those terms, the way the budget has worked out, yes, you've got the fiscal deficit coming off much more than had been targeted, and most people hadn't even expected this. But much more importantly is the way the government has actually played around with the expenditure side of the budget.
Yeah.
And the expenditure side of the budget tends to suggest that if one looks at it a little carefully, the pace at which government expenditures will move will be higher than what we had last year.
Yes.
And that is the important thing. So there is, as far as monetary policy is concerned, you have a situation where the government draws on its balances. It's going to be large. Which you will have to keep an eye on. Now, this is a short-term thing. It evens out over the course of the year. But the point is that everything depends upon how the pattern of government expenditure correlates with the cycle.
Fair point, sir.
And that is something we need to keep our eyes on. And the RBI will certainly need to keep its eyes on that.
Fair point, sir. So liquidity, that adds, if the government is going to spend very quickly, that will already ease. So need the MPC or the Reserve Bank do anything? That question after the break to my experts. Also, there is a neutral rate which the Reserve Bank has kind of put on the table. All those questions after the break to the members of the Citizens Monetary Policy Committee.